March 2025. A closed door, no cameras, no press release, and the world's most powerful economies just held an emergency meeting about silver. This is Money Simplified, and today we are connecting the dots that mainstream finance is praying you never put together. The silver market is breaking down structurally. Governments are reacting behind closed doors. Institutions are repositioning silently. Industrial demand is accelerating, and the price is still lagging behind a reality that is far more urgent than anyone is admitting. We are going to walk through the data, and I promise you by the end of this, you will never look at silver the same way again. Let's start with the number that kicked this whole thing off. According to the Silver Institute's World Silver Survey 2025, the global silver market just recorded its fifth consecutive year of supply deficit. In 2024 alone, demand exceeded supply by 148.9 million ounces. That's nearly twice the annual mine output of Mexico, the world's largest producer. In 2025, while estimates vary, Metals Focus projected a deficit of 117 million ounces, and some analysts tracking unallocated ETF demand are calling it closer to 295 million ounces. But here's the part that makes this truly terrifying. Because most people hear shortage and they think the market will just fix itself. Higher prices bring out more supply, right? Wrong. Mine supply is not responding. According to the Silver Institute, global silver mine production has actually declined by 7% since 2016, and 2025 mine supply is forecast to remain completely flat at around 813 million ounces, with higher production in Mexico and Russia being fully offset by declines in Peru and Indonesia. We are essentially mining the same amount of silver we were mining a decade ago. Meanwhile, industrial demand just keeps growing. That's the first bomb that's about to go off. Now let's talk about why the G7 got involved. Because you don't call an emergency meeting over a commodity unless that commodity is critical to modern industry. Silver is not just jewelry, it's not just coins. According to the Silver Institute, the photovoltaic solar sector alone consumed over 6,000 metric tons of silver in 2024. Every solar panel needs silver paste to conduct electricity. Every EV needs silver for its electronics and battery contacts. Every 5G tower needs silver. Every AI data center needs silver for its connectors. This is not speculation. This is verifiable industrial demand that is growing at a compound annual rate of roughly 4%. And now factor in the wildcard that silenced the room. Samsung SDI has developed a solid-state silver carbon battery breakthrough. Industry reports estimate that this new design requires roughly 1 kilogram of silver per 100 kilowatt-hours of capacity. A typical EV battery pack of 100 kilowatt-hours would contain about 1 kilogram of silver under Samsung's design. If just 20% of global car production, roughly 16 million vehicles, adopted this technology, the annual silver demand would hit 16,000 metric tons. That is an industrial demand shock of a magnitude that the silver market has never seen. And that is exactly why the G7 is panicking behind closed doors. But here's where the story gets even darker. Because it's not just about demand. The supply side is simultaneously imploding. Let's start with Mexico. Mexico supplies roughly 25% of the world's silver, and Mexico is in crisis. According to industry reports, Mexican silver production fell for the third consecutive year in 2025, dropping 5% year over year to 172.9 million ounces. But the real story is not just declining ore grades, it's the cartels. According to Mexico's mining chamber, 97% of mining companies have reported criminal interference, including extortion, forced use of cartel-affiliated suppliers, and attacks on mining camps. In March 2025, First Majestic Silver's San Dimas mine was forced to close due to extortion. Silver transportation convoys are being hijacked on highways. This is not a supply constraint. This is a supply collapse driven by organized crime. And while Mexico crumbles, other producers are not stepping up. Peru is declining. Indonesia is declining. The only major producer showing growth is Russia. And that brings us to the second reason the G7 is terrified. According to Russia's draft federal budget for 2025 through 2027, Moscow has allocated 51.5 billion rubles, approximately $535 million, for precious metals acquisitions. And for the first time in decades, silver is explicitly listed alongside gold, platinum, and palladium. Russia is stockpiling silver. A nation that has spent 2 decades building a gold war chest is now adding silver to its sovereign reserves. And here's the geopolitical kicker that the G7 is losing sleep over. If Russia is buying physical silver, and China is already the world's largest industrial consumer of silver, and India is reopening its import floodgates, the Western economies could effectively be locked out of the physical market. Which brings me to India. In September 2025, India's Directorate General of Foreign Trade issued an emergency notification imposing fresh restrictions on silver jewelry imports to curb what the ministry called large-scale imports of silver in the guise of finished products. But here's what they're not telling you. The real story is that India just reopened its import channels for high-purity silver ahead of the Diwali demand season, and the volume is staggering. India is the world's largest silver consumer after industrial use, and every year, the country imports hundreds of millions of ounces to meet jewelry and investment demand. The DGFT's move effectively streamlines those imports through official channels. That means India is about to become a massive buyer in a market that is already structurally undersupplied. Now let's look at the physical market data that should terrify every institutional trader. According to data from the London Bullion Market Association, silver vault stocks in London plummeted to 136 million ounces by September 2025. That is a 62% decline from the 360 million ounces recorded in early 2021. And here's the part that makes this a crisis. London's silver inventory fell to roughly half of the market's daily trading volume. Think about that. The world's second-largest silver trading hub now holds less physical metal than trades hands in a single day. And COMEX is not much better. In the last 2 weeks of September 2025 alone, 29 million ounces of silver were withdrawn from COMEX warehouses. On October 10, 2025, the exchange saw its largest single-day withdrawal of silver in 4 years. According to analysts tracking the data, COMEX registered silver inventories have plummeted roughly 70% since 2020, and as of December 2025, the ratio of open interest to registered inventory stood at 8-1. That means for every 1 ounce of physical silver available for delivery in COMEX warehouses, there are 8 ounces of paper claims against it. And here's the smoking gun. According to Bloomberg and other sources, JP Morgan, HSBC, Deutsche Bank, and UBS collectively hold short positions worth an astonishing 60 billion ounces in COMEX futures. That is 70 times the entire annual global silver production of roughly 850 million ounces. Let me repeat that. 70 times. The banks are short a quantity of silver that would take 7 decades to mine at current rates. And when the physical delivery demanded starts coming due, there is not enough metal in the world to cover those positions. That's not a market. That's a time bomb. And the market is already signaling that the bomb is ticking. Silver lease rates in London surged from just 0.5% to 39% in December 2025. The 1-year forward swap rate dropped to negative 7.09%, meaning buyers are willing to pay a premium to acquire physical silver immediately. Historically, lease rates above 1% signal tightness. 39% signals a full-blown physical squeeze. According to analysts, this surge reflects that the shortage is not merely speculative or paper-driven, but rooted in a genuine lack of deliverable metal. At the same time, the price gap between London spot and COMEX futures widened to $3 per ounce, triggering a wave of emergency air shipments of silver bars across the Atlantic. Silver is being flown from New York to London to cover shortages. That never happens for a commodity that is trading in surplus. This is a market under extreme structural stress, and the price has not yet caught up to the reality. Now let's talk about the gold-silver ratio, because this is where the smart money is placing its bets. In April 2025, the gold-silver ratio spiked to over 100-1. By the end of 2025, that ratio had compressed to below 60-1 as silver's price surged 144%, while gold gained just 65%. And in early January 2026, silver hit an all-time high above $121 per ounce before retracing. But here's the part that matters for the future. The ratio has since snapped back to around 75-1, which is still historically elevated. The long-term average since 1990 is roughly 70-1. The historical mean is closer to 50-1. By that measure, silver remains undervalued relative to gold by at least 30%. And when the ratio compresses from 100 to 50, the returns for silver investors can be multiples of what gold delivers. But the real story here is institutional positioning. According to 13F filings, BlackRock held more than 18 million shares of the Sprott Physical Silver Trust as of December 2025, valued at over $500 million. Meanwhile, retail favorite iShares Silver Trust saw net outflows as institutional money rotated from paper ETFs into fully allocated physical trusts. The message from the big money is clear. They do not want derivative exposure to silver. They want the metal itself, sitting in a vault with their name on it. Let me leave you with some numbers that should redefine how you think about your portfolio. According to the Federal Reserve's Survey of Consumer Finances, the median retirement savings for Americans near retirement age is roughly $185,000. In an environment of 4% inflation, that purchasing power will be cut in half in just 18 years. Meanwhile, a modest allocation of 10% to physical silver, held for 5 years through the current structural deficit cycle, would have historically returned multiples of that. I'm not telling you to go all in on silver. I'm telling you that ignoring the structural breakdown in the supply and demand balance is a risk most people cannot afford to take. Here is my call to action. Go look at the data yourself. The Silver Institute's World Silver Survey is free online. COMEX inventory data is public. The lease rate charts are published daily. The G7 Critical Minerals Action Plan is publicly available. The fact that the mainstream media is not covering this story is not because it's not important. It's because it's dangerous to the established financial order. The banks are short. The governments are worried. The mines are failing. The industrial demand is accelerating. The inventory is draining. And the price is still sitting at levels that do not reflect any of this. You have the information now. What you do with it is up to you. But do not say you were not warned. If you want to go deeper, subscribe to Money Simplified. We track the macro signals that the mainstream ignores. And if you made it all the way to the end, comment down below with G7 signal confirmed and tell me what you think the G7 actually discussed behind closed doors. I'll see you in the next one.